What if I told you that Wall Street is not betting on America anymore, and the exit already began? Right now, while headlines celebrate stock market highs and economic resilience, the largest financial institutions in the United States are quietly pulling capital out of domestic markets at a scale we haven't seen since before the 2008 collapse, not billions, trillions. And they're not moving it into safer American assets. They're moving it offshore, into foreign currencies, hard commodities, and emerging economies that most Americans have never even thought about. This isn't a hedge, this is an exit. And the people orchestrating it are the same ones who've spent decades telling you that America is the safest place to park your wealth. So why now? Why are the institutions that built their empires on American growth suddenly acting like they know something the rest of us don't? The answer isn't in the news, it's in the math. And the math stopped working. For 40 years, Wall Street's dominance rested on a simple formula: borrow cheap dollars, invest in American growth, repeat. The Federal Reserve kept rates low, the government kept spending, and the system kept expanding. But that formula depended on one critical assumption: that U.S. Treasury bonds would always be the world's safest asset, that foreign governments and institutional investors would always buy American debt, no matter how much we issued, that the dollar's reserve currency status was permanent. That assumption just broke. In 2023, something unprecedented happened. Foreign holders of U.S. Treasury bonds began selling. Not rotating, selling. China dumped over $100 billion in treasuries. Japan, the largest foreign holder, reduced its position for the first time in decades. Saudi Arabia and the UAE quietly diversified into euros, yuan, and gold. These aren't random moves. These are coordinated exits by nations that used to anchor the entire demand structure for American debt. And Wall Street noticed. Because when foreign buyers step back, someone else has to absorb trillions of dollars in government debt. The Federal Reserve tried. They printed money and bought bonds during the pandemic, exploding their balance sheet to nearly $9 trillion. But now they're tightening. They're selling those bonds back into the market. So who's left to buy? Domestic institutions, pension funds, banks, insurance companies. The very entities that are now pulling their money out. Here's the trap. U.S. government spending isn't slowing down. Deficits are still running This is capital flight in slow motion. And it's happening because Wall Street sees the same thing every empire sees right before the center stops holding. The cost of maintaining the system is starting to exceed the benefit. The U.S. military budget is over $800 billion a year. The interest on the national debt just exceeded defense spending for the first time in history. Social Security and Medicare are mathematically insolvent without reform. Infrastructure is crumbling. Political gridlock makes meaningful policy change nearly impossible. And meanwhile, China is spending trillions on the Belt and Road Initiative, Europe is racing toward energy independence, and the BRICS nations are building payment systems that bypass the dollar entirely. Wall Street isn't ideological. It doesn't care about flags. It cares about returns. And the return on being the last one holding U.S. assets in a de-dollarizing world is negative. You're not supposed to notice this yet. The media won't tell you. They'll talk about inflation, about interest rates, about whether the Fed will pivot. Those are symptoms. The disease is structural. The disease is that the global financial system is quietly building an exit from U.S. dependence, and Wall Street is leading the way out. And here's the cruelest part. When the exit accelerates, it will be framed as a crisis, a shock, an unexpected collapse. But it's not unexpected. It's planned. Not by a conspiracy, by incentives. Every major institution is acting rationally in its own interest. They're just not acting in yours. Because here's what happens when trillions of dollars leave a system. Liquidity dries up. Asset prices become unstable. Borrowing costs spike. Companies that depend on cheap credit start failing. Pensions that assumed steady returns face shortfalls. Local governments that relied on tax revenue from financial firms see budgets collapse. And the people left holding dollar-denominated savings watch their purchasing power erode in real time. This isn't speculation. This is what happened to Britain after World War II. It's what happened to the Soviet Union in the 1980s. It's what happens to every reserve currency when the world stops needing it. And the world is actively building systems that don't need the dollar. China and Russia are settling trade in yuan and rubles. India is buying Russian oil in rupees. The UAE is accepting yuan for energy exports. The European Union is pushing for euro-denominated energy contracts. Even U.S. allies are quietly preparing for a multipolar currency world. Wall Street sees this. They have analysts in every major capital. They have access to flow data that governments don't publish. They know which central banks are diversifying. They know which sovereign wealth funds are reducing dollar exposure. And they know that once the momentum shifts, it doesn't reverse. So they're not waiting for confirmation. They're not waiting for a press release from the Federal Reserve or a speech from the Treasury Secretary. They're moving now, while the exits are still wide and the assets they're leaving behind still have buyers. But those buyers are getting scarce. In 2022, the Federal Reserve raised interest rates faster than at any point in 40 years. The goal was to fight inflation. The result was a liquidity crisis. Regional banks started failing. Silicon Valley Bank collapsed in a matter of days. Signature Bank, First Republic. These weren't isolated incidents. They were symptoms of a system that can't handle higher rates because it was built for an era of infinite cheap money. And yet, rates are still nowhere near historical norms. We're calling 4 or 5% high. 30 years ago, 10% was normal. If we ever return to truly restrictive monetary policy, the entire structure collapses. Wall Street knows this. So they're not betting on a return to normalcy. They're betting on a managed decline. Managed by whom? By the people leaving. Because here's the dirty secret of every financial collapse. The people who see it coming don't warn you. They position themselves to profit from it. They short the assets they know will fail. They move into hard assets that hold value through chaos. They build optionality in foreign markets so that when the domestic market stumbles, they're already somewhere else. This is why you didn't hear about the exit. This is why it's not on the front page. Because the people who control the narrative are the same people who are leaving. And they need you to stay calm, stay invested, and keep buying while they sell. You're watching the greatest wealth transfer in modern history, and it's being packaged as business as usual. So what does this look like when it accelerates? It starts with volatility, wild swings in asset prices that don't make sense, a stock market that rallies on bad news and crashes on good news because nothing is being driven by fundamentals anymore. It's being driven by liquidity, by margin calls, by forced selling from institutions that over-leveraged in a zero-rate world and are now scrambling to meet obligations in a higher rate environment. Then come the headlines. A major bank announces restructuring. A pension fund discloses a shortfall. A municipality defaults on its bonds. Each one is treated as an isolated event. But they're not isolated. They're connected by the same thread, the assumption that America would always be the safe bet. And then comes the policy response. The government steps in. They'll call it a rescue, a stabilization. They'll print money, cut rates, backstop losses. And that might work for a while. It might calm the markets. But it will also confirm what Wall Street already knows. that the US is willing to destroy the value of its currency to preserve the appearance of stability. And that's when the final wave leaves. Because if you're holding dollars and the government just signaled it will print unlimited amounts to avoid default, you're not holding safety. You're holding risk. The math is already locked in. The debt is too large. The deficits are too structural. The political system is too paralyzed. And the rest of the world is too far down the path of building alternatives. Wall Street didn't cause this, but they're not going to be the ones left holding the bag when it unravels. They're already gone. So let me ask you this. If the smartest money in the world is quietly leaving, and they're not telling you why, what does that say about where you're standing? The exit no one expected wasn't unexpected at all. It was just invisible. Until now. Here's the question I want you to answer in the comments. If you knew major institutions were pulling capital out of the US, what would be the first move you'd make to protect yourself? Not advice, just your instinct. Let me know below. And if this connected dots you hadn't seen before, don't keep it to yourself. Share this with someone who still thinks the system is stable. Because the window to understand what's happening is closing faster than the window to react. This was the exit no one expected. But now you know. And knowing changes everything.